So in today's review, I'm going to take you through a few things. As you guys can see, last week was a busy week with 6 trades in total, 2 winners, 4 losses, and closing the week about 1.5% down, given the account was just below the starting balance. So 1.3 would have been at break even, but we were in a minor drawdown. So it's about 1.5%. Um, so we'll go through the weekly review. It was also the end of October, so I'll take you through the monthly performance. And then, with it being such a busy week, I completed my second set of data collection. Um, as you know, we obviously collect data over 20 trades and then review at the end of that 20 to then revise the plan. So I'll take you through briefly how I did on this first 20 and then how then the plan has changed slightly for those last, well, now going forward into this next set. And yeah, good to go through. So let's get stuck in. So yeah, if you want to see the detailed trade recaps, I didn't go through all the positions, but I think I covered 4 or 5 of the 6 taken. You can find those on TradingView. The link to that isn't in the description. So yeah, be sure to check that out. That's going to go quite in depth on each position, as well as then how I was forecasting throughout the week. But in terms of sort of what I did well in the week. Um, One was using a more secure stop position on EU, regardless of the reduced R multiple. And this was in a scale-in position. And so normally when I scale into a position, I'll place the original positions normally at break even, and then I'll place the scale-in position's stop loss at that same position. And while this was it gave decent protection on the stop or on the position, there was just a better placement that I thought would be more effective. That was just a bit higher up. I think it had a key indicator area protecting it, and so opted for that. Reduced the risk to reward. But what happened in that position was that price actually stopped me out on the original position and then kept going, and I was able to bank some profit on that scaled in position, which actually produced a tweak in my current plan where now I use a bit of discretion when I do adjust my stop to both break even as well as half risk. In that, I just look at what structures near, and if it means setting break even means setting it in a minor loss, then that's fine, as long as if the position does stop me out, I'm net profit at the end of the day. But then obviously with the half risk position, um, it should still be within a half risk kind of range. I don't want to leave too much exposed, but it's just being mindful that it won't always be 50% on the dot, depending on how structure's forming. So that was something that I did quite well. And then, yeah, I think just ensuring clarity throughout my forecasting sessions, looking at both sides of the trade, which is something I didn't do in the previous week. But yeah, that led to a missed trade, which I think would have been running in profit. But arguably, in that situation, there was a bit of uncertainty around the technicals. So I see it as a good thing in hindsight. And then what mistakes did I make last week, or what did I not do so well? I misread, distribution on AUS protraction. This is AUD USD, when it had actually shifted 1 hour structure, which then, in hindsight, didn't align with my trade parameters, making that an invalid trade. Um, and then I did not identify what would have led me to be risk off on a setup, and was only focusing on execution characteristics, which is something I was kind of bouncing between doing well and not doing well last week. And then, yeah, I had a strong sort of bias towards dollar strength, which led to marrying the bias and resulted in that invalid trade. So that was the trade on AUD/USD where, I misread that distribution as a protraction because I was so invested in seeing price play out in a particular direction. So it got me a bit too zoomed in. And then at that point, you don't consider what could potentially happen because you're so focused on one thing playing out. And I think that's just a big takeaway for anyone, is that you got to remain neutral, even if you have strong conviction in your bias, it meets the plan. One thing I urge you to do is just constantly consider both sides of the trade. What could make this? And even if there isn't an argument for the other side, at least have a line in the sand where you say, if price action does this, then I'm either going to be risk off or I'm going to switch my bias. Because otherwise, then, you look for price to retrace to a certain point. It does that, but then it just goes way beyond, and you're just so invested in things playing out a certain way that you're not even taking notice that, something's changed. So yeah, that was something. Yeah, I didn't do too well last week. And then the last one actually isn't valid because after reviewing that further, it actually just didn't fall into the plan. So that's fine. And so, what did I learn from the things I did well and the mistakes I made? Break-even positions for stops can be slightly in the red if it offers better protection, especially if I have secured profits. Yeah, we spoke about this a bit, further up. And then I also learned that my plan doesn't differentiate between how I interpret max drawdown if a loss occurred during Asian session as opposed to the two sessions I trade, being London and New York. This goes back to the AUD/USD position. While there was trade parameters not being met, technical uncertainty, I'd also taken a loss on USD JPY that morning, but then still executed two positions for the day, which was technically a violation of my risk management, where I can only take a maximum of two consecutive losses. And so if I've already taken a loss, I can only take one more position because I don't know how that position is going to play out. And so that was another mistake that I made on that AUD/USD position, which kind of reaffirmed that it really was an invalid trade. And so what can I do better next time? I think just reviewing my trade management when revising the plan, that's something I've done. And, I've done this, which is just adding a section in that makes me aware of my trade and risk management protocol in my forecasting template. And that just really just checks, it's just a plain statement or question. Does this trade fall in line with my risk management? And then I've just got a small comment that says, example, I'm not breaching like my max drawdown or whatever if I take this. That's just like a good reminder that I may be potentially violating my plan, because sometimes when you're in the moment and it's been a long day, you forget certain elements of your plan. So I think that was a good, just minor tweak that I've implemented going forward. And then also identifying risk off criteria in my trade setups, just to remain neutral in the moment. And this, I think, is a longer term thing that kind of need to develop. At the moment, I'm just doing it in my forecasting session. So if structure does ABC, then I'm going to be risk off, and it arguably might be that, but I wanted to take a bit more time to sort of develop that, because there may be a mechanical way to do it that I'm not yet seeing. So I didn't want to just make a very strict kind of rule in my current revision, because I'm also being very selective with how how much I change this plan, because it is a plan where the current data indicates is a profitable strategy and gives me some sort of edge in the market. So I want to build off the positives, while still obviously filtering out what's not working in the plan. And so that then sums up, I guess, the journey of what was last week's 6 positions. All in all, a great week where I think I executed executed well, according to the plan for the most part, except that one position. But then I think a good way to end the month, that then just obviously ended off that second set of data collection, and then going into these next 2 months, have now the revised plan that I'm now testing, which will probably take me potentially to the end of the year. And so when we come to our report section, I'm in the wrong place. I'm just going to set a date range for October, just so we can see how we did here. And it was a profitable month, 5.3%. If we're looking at obviously $100,000 account, $5,300. And just looking, number of trades, about 13 trades, which I think is quite healthy. Obviously, a lot more towards the end of that week. But if I just look at some key characteristics or key metrics that I look for, just to almost reaffirm whether the edge I'm trading is profitable or not, looking at things like my largest profit versus my largest loss. My largest profit is about 5 times the size of my largest loss. It's a healthy indicator. It means that my risk to reward ratio is quite healthy. Looking at my average daily P&L, it's positive, which is basically the average sort of outcome I expect each day of trading. And it's about 0.5%, $500. Another stat, just kind of my average winning day P&L versus my average day losing P&L. That is 2 times the size of my losses, which is also positive. And then also, and I think this is an important one, your largest profitable day versus your largest profitable loss. I'd argue your largest losing day is a better indicator of a sort of mature or profitable edge, because you want that to be as close as possible to your average risk as possible, sort of as close as possible to your average risk. You don't want that to be you don't want that to deviate too far from what you risk on average. And I think this being at $720 is like smack dead in the middle of what I sort of risked over this month. I think it was a combination of 0.5%, $500, and $1,000, 1%. And so that reflects sort of my average risk over that period, which is really solid. And then your largest profitable day, look, you'll have some days where it's just mega, but I think if it's a decent R multiple higher than your largest loss, then that's a good sign. One part of the plan or one metric where I think could use a lot of work is my average planned R multiple and my average realized R multiple, which basically means on average I'm planning, or I set out about to capture 4R, meaning risking 1 to obviously secure 4 times that. But then my average realized R multiple over the span of trades is relatively low, significantly lower than what I'm planning. So there's a bit of a gap in there, which may come down to the way I'm managing trades, because look, at the end of the day, I'm still profitable, but it may mean that I'm not capturing as much profit as possible. So yeah, definitely something to look into there. And then yeah, maybe just coming to the dashboard, because that gives a few metrics there. So trade win percentage, this is basically percentage of winning trades out of total trades taken. It's kind of like it reflects the strike rate in a sense. 46% is quite good, because one of my goals for this plan was to achieve a strike rate of 40%. Previously, with the coming out of the first set, this was sitting at 40, not 40, it was 33%. And so that's about a 13% increase in my strike rate. day win percentage reflects the percentage of winning trading days out of total trading days. 70% I think is very healthy, which is on average winning a lot, ending days profitable as opposed to obviously losing. um and then yeah, this just kind of highlights the kind of journey of that. This is September. Looking at October, um you can see definitely a lot more profitable days. There were losses in here, but I think yeah, obviously because the outcome is normally higher than the well, profitable trades are normally close out a lot higher than what I lose. Um, if I take more than one trade on a day and there's a loss in there, it's going to get absorbed by that win. And so, really strong, I think, performance for October. And now maybe just expanding that a bit because I did start this 20 set at the beginning of September when I started the $100,000 challenge. Um, so it essentially extended over the previous 2 months. And so when looking at September, just starting out here, just kind of encapsulating the full 20 trades. It doesn't show it here, but there's another, um, I think under my trades, it shows the number of trades. But I think what we can see is that September was, another 5.3%. October also 5.32, literally almost exactly the same. So quite chuffed that there was consistency across the 2 months. I think obviously an element of frustration and the expectation to want to obviously pass phase two um, before the end of October. But zooming out and looking at how I did over the 2 months, there was definitely consistency in the results. Again, when I factor in the other, if it was 13 trades in October, then it was about 8 trades in September. The trade win percentage just comes up a bit, but still at that like 47 odd percent. Day win comes down a bit to 66%, but profit factor, still positive. Average win loss, still positive. And then looking at the reports, um, very similar. Obviously, my largest profit, largest loss was the same. I think this was from October. But you can see average planned R multiple, still a bit of a gap there. So consistency again over September and October. Largest profitable day, largest profitable loss. I think those are October's figures reflecting there. But then average daily P&L still positive. Average winning day still about double what my average losing day is. And so yeah, there wasn't much change when I incorporate that data because again, it just reflects the consistency. And you can see here, best month, obviously $5,300, lowest month, $5,300, average is that. But while it's good, it's not a lot of data, but definitely something that I feel I can be sort of proud of, just given what the first set was looking like, um, which was quite interesting. And so spent a bit of time this past weekend looking at all this data on TradeZella, kind of going through a few of the trades myself, and then asking some questions, going back to previous trades, taking a look at them in a bit more detail, and coming out of it, there were a few tweaks, not a lot. The biggest change, I think, from the plan was now differentiating between what a higher risk setup looks like and what a lower risk setup looks like. And that kind of came from a video I watched from Ibi Ansari from Falcon FX. So shout out to him for that. And it's in a video where he almost goes through his trade building protocol, which essentially tries to get to the root of what your biggest inefficiencies are as a trader that you need to work towards improving. And in that video, he kind of starts with saying that most traders don't realize that, on the edge, that every trading setup you have has a high risk variation and a low risk variation. And then he goes through, a protocol around how to, test this. And, there's a whole lot of detail there. Not going to get into it now, but if you want to check it out, check it out. That's Ibi Ansari. And I think the title of the video is "If You're Confused as a Trader, Watch This." So that was from when I watched that video a couple of weeks back. I'd already started kind of thinking about this because that isn't something I incorporated into this plan. But then obviously with this revision, not I didn't want to make too many changes to the plan, but I knew this was something, from the first time I listened to it that I had to incorporate into the plan. And so what I think the challenge for me came into trying to determine which part of my plan I incorporate that into. Meaning when I come to the high time frames, which are pretty much the same. If there's one change that I did incorporate, is that with my sniper entry here. Previously, I'd only look for the daily or the 4 hour to be to have mitigated or formed an order block. I've now included fair value gaps in that. And that's really the only change here. It's a bit of wording. But in essence, I have 4 setups here because there's obviously the resistance setup. We either aren't at EPD on the daily, we've established a trend, and we are taking a trade in the direction of that counter trend towards EPD, which is the same as being at EPD, but still, maintaining a 4 hour counter trend and trading in the direction of that same setup resistance. Sniper entry, we at EPD, 4 hours still counter trend, but now our entry's pro trend, kind of calling the top of the bottom. That's a second setup. Third setup is our optimal alignment. At EPD, the 4 hours now shifted pro trend. My entry is then also pro trend in the direction of that daily bias, but then the 4 hour obviously complementing that, also being in alignment with that optimal alignment. And then the pullback rider at EPD on the daily, 4 hours shifted pro trend. But then we are now trading a correction, essentially counter to that 4 hour trend as well as that daily bias. And so there was a question of, is this where I can almost identify the high or low risk variation? And I pondered on it a bit, but then I almost decided that it would be too complicated to introduce it here. And so what I almost concluded was, with all of these setups, there are effectively 2 ways that I can take these setups. And that's when we come to the trade parameters, which haven't changed much. If there's one change, it's that with my 15-minute IPDA entry, the 15-minute just requires a time-based liquidity sweep. Because previously it was, obviously protraction, and then is there key area mitigation or time-based liquidity sweep. But for this entry to be valid, it needs a time-based liquidity sweep. And I realized I don't really need a key area mitigation. And so filtering down from those 4 primary setups, I essentially have 2 setups that I take when any one of those 4 are shaping up. And I think when I get into these 2 setups, it then becomes clearer as to, when I'm about to execute, what situations or what characteristics or scenarios have I found over this 20 set that I've almost instinctively picked up on as a trade being higher risk or lower risk. And I think that's where a lot of kind of the major insights or I guess I can call it an insight, came from. Um, and so just briefly on my the first question I ask is my trade in alignment with the 1 hour range? If yes, I look at price to be at EPD, right? we hear. And what I found from the data was that for me, EPD is 50% equilibrium, 62%. That's the beginning of your optimal trade entry area, which ranges from 62% to 79%. Then the midpoint of that is 70.5%. All four levels that I've taken trades from, because I document that, all four levels are profitable, and there's varying ranges of that, and varying ranges of what losses I take from certain levels. But the data indicates from this past 20 sample size that the 70.5 and the 79% level have yielded higher profits and lower losses. And so then almost saying that the deeper the retracement on this 1 hour, the lower risk, in a sense, a position becomes, because it has a higher probability of playing out, as opposed to the shallower pullbacks, 50 and the 62. Although they still work, the data is what the data is. And so that was a cool way that I kind of used my results to confirm what I'd kind of almost been seeing already. Arguably, though, I would have argued that the 79% level wasn't one of the better performers, because sometimes when price gets beyond that level, it just doesn't stop and it overshoots. So there was that. But that's something I've added now to the plan. On the other end of it, with my IPTA entry, which is arguably an entry I don't use a lot, but I think while it's underutilized, I do feel like there's a lot of value there. And I think I'm going to spend a bit of time in this next set back testing this entry to make sure that I'm taking advantage of it when it does form. But this is where a lot more discretion comes in, and it's basically identifying a clear generation of liquidity in one direction to then observe when the opposite happens as an indication of a shift of structure. And I'm going to do back testing sessions to go through this and clarify it if it doesn't make too much sense now, but re-listen to this also if you have time, or if you're wanting to understand it better. But in essence there, and I didn't have data to almost look at this objectively, but how I've differentiated between lower risk and higher risk is that on a lower risk variation, there are multiple confirmations of liquidity being generated in a certain direction before the point at which I'm looking for a reversal. And I've said in my plan, if there are two or more points where I can clearly see liquidity is being swept and redistributing in a certain way, then for me, I can classify that as a low risk setup. And for a high risk setup, I only need 1 point of liquidity being swept and then a distribution for then the next consolidation, where I'm looking for the opposing end of liquidity to be swept before distribution. And so those are kind of the major changes in the plan. The entry confirmation hasn't changed at all. If there's one thing that has changed, it's my trade management. I've now extended my max consecutive losses to 3 positions, and that just goes into this trade building protocol that I'm doing now, because I'll be taking a few more setups, I think, than I normally do. And if you want to understand why, watch the trade building protocol video by Abi Ansari. So yeah, that is the revised plan. As you guys can see, not many changes, and I've done that intentionally, because I think we're working with something good now, and I don't want to tweak it too much to where I throw things off. But then always for transparency, the account metrics page, account size, equity, and yeah, this is just kind of reflecting an open position I have on pound JPY, and then yeah, everything else is the same. 7 trades, 6 last week, 1 the week before. Yeah, that's for you guys. So yeah, remember guys, consistency is the choice you make when you start doing the things you know you should be doing day in and day out.